Hello accounts people, time to have a look at an extended trial balance question. Typical extended trial balance question here. We have the main accounts that cause confusion, so I've made sure they're in there. We start off with our trial balance figures, our ledger balances, including in this case a suspense account, and then we make the adjustments, so our year-end adjustments like our depreciation charges, prepayments, accruals and the corrections, which is why hopefully when we work it out we'll have cleared our suspense account. And with the extended trial balance, we're going to determine which figures belong in our statement of profit or loss and which belong in our statement of financial position. The columns won't add up correctly because the difference is our profit or our loss, and then those numbers we can put straight into our financial statements, our end of year accounts. These asterisks here just indicate items that can be debits or credits, but nothing ever gets confused, nothing ever goes from one statement to another depending on the value. So a quick little look at what goes in the accounts. So profit or loss is expenses and income. Anything to do with trading, it's over a time period, usually over a year. These accounts then, they're closed off at the end of the year, transferred to the profit or loss, which we treat as a ledger. The only time you'll see a brought down balance for the start of next year will be if there's accrual or prepayment on them. So the statement of financial position contains assets, capital, liabilities, or anything that's just the value of assets or liabilities. And it's the financial value of the business, usually again at the end of the year. So this is a point in time as opposed to a time period. So these are the accounts that we balance off with carry down at the end of the year and just start again with brought down. Last year's closing balance for our bank is next year's opening balance for our bank. So I'll put some of the awkward ones in, so if I make a mistake that's why. But we'll start off with this one. So we've actually reduced the provision or the allowance for doubtful debts. In this case, credit and debit, which is why the adjustment goes in our profit or loss in the credit side, so it's sundry income. It will increase our profits. Accruals, then, that's a bill that we've earned. We've had the expense, we just haven't got the bill to put in our account. It's a liability, it's a current liability to be precise. And then our bank account, made the numbers awkward. The ledger balance said £400 or cash book overdrawn, but there must be 500. We'd forgotten that we'd paid in. So actually it's an asset, £100 as an asset. And then capital always goes there. Notice no drawings. There shouldn't really be drawings in an ETB because drawings are taken off the profits to work out how much gets added to our capital in our financial statement. Cash is an asset. We have it, we own it, it's ours, we control it, we're going to use it to generate economic revenue or economic value. Closing inventory then, so it's easy to understand why the stock on our shelves is an asset. This one though, what we're actually doing here is taking it off our cost of sales for the year because it's next year's cost of sales. We haven't used it yet. And it's a manual adjustment because we go around and add up the value. We can't rely on ledgers because things disappear or haven't been recorded correctly. That's what the stock takes for at the end of the year. Depreciation charge or expense, that's just the annual charge. And you'll notice the 2,750 then added to the accumulated depreciation later. Insurance, not to be confused with what you get for your car, it's a bill, we pay for it. And our machinery is our asset, and then it gets reduced in value. The actual value that will show will be the carrying value, the difference between the machinery and its accumulated depreciation. Expect to see an adjustment here because that's our opening balance plus our used depreciation. And in our office expenses then we've got a debit and a credit at an expense. It says so. Oh, somebody has made a mistake somewhere. So I better make sure I don't make another one. And then our opening inventory, well, this asset will be credited statement of financial position, debit the statement of profit and loss at the start of the year. So this is what we did at the start of last year. and it'll be added to our purchases for work out what we've actually used. Payroll expense is another correction. It's an expense figure, easy when it's got the word expense in it. But 2 debits, so we're adding them. And then the prepayments, it's an asset that we pay for something in advance. It's money not in our bank account, it's already in our suppliers or whoever it is. Purchases then our main expense, certainly in this case, not to be confused with our purchase ledger control account, the amount that we owe our suppliers. And then our sales needs a bit of adjustment, credit and a debit, so income minus an adjustment, maybe a return we forgot about. And then a sales ledger control account, an asset, people owe us money, when they pay it, it will be debit the bank, credit the sales ledger control account, and it turns into a bank asset instead. The 31,400 minus the 1850 will be our receivables in our accounts. Got expenses in, again, a nice easy one to work out. So the expense account then, so okay, 450 debit plus 500, 950 debit minus 950 credit should be 0. It doesn't belong in either the profit or loss or the statement of financial position, because if it's a expense account we don't know what it is, otherwise we would have sorted it out. One that's confused occasionally, this is a liability. We've taken some money on behalf of the government off our customers and we're going to pay it over to the government. Although we write a cheque out for it, it's not actually an expense, it's a liability. We will pay it at a date. So now we get to the bottom figures. This case, 139,300 income minus 127,850 expenses gives us 11,450 profits. That's our debit entry. We can either work it out again, 8,1200 minus 69750, or we can put the 11,450 in and make sure these columns now add up correctly. So that's our figures ready to finish our financial statements. If it doesn't add up, well, who knows what can happen. It could be a typo, so generally speaking I would recommend, first of all, check for typos, check for numbers the wrong way around. Then check that we've got debits and credits right, particularly where there's an adjustment, 2 debits adding up, 2 credits adding up, but if it's a mixture it reduces, and make sure they're in the right columns. Whether it's a debit, it goes into a debit, very easy to do. And then if that fails, go through the expenses one by one, just identify each expense, make sure it's a debit in the statement of profit or loss, make sure the income is where it belongs, and then assets, liabilities and capital are in the right account. Bear in mind, if you put something in the wrong statement but on the right side, you would still get the same profit figure. Don't spend too much time trying to change everything, because you'll end up making a right mess of it and you'll end up with a worse answer than you started off with.